Barbara Thornton opened her tax return on a Tuesday morning in early March. She was 68 years old, 31 years as a school nurse in Louisville, Kentucky. She had done everything right. She saved. She waited until 66 to claim her Social Security. She was pulling carefully from her IRA, $2,500 a month, to cover her expenses and leave the rest to grow. Then her tax preparer pointed to one number on that return. Federal income tax due, $2,432. Barbara stared at it. She had $22,080 coming in from Social Security that year. She had worked her entire career and paid into that system. And now, after she retired, after she stopped working, the government was handing it back to her and taxing it. She asked her preparer, "Is there any way to stop this?" The preparer shrugged and said, "That's just how Social Security works." That is wrong, and it is costing people like Barbara thousands of dollars every single year. Not because the law changed, not because she did anything illegal, but because nobody ever explained what the IRS is actually measuring and what it cannot see. Today I'm going to show you exactly what the IRS looks at, exactly what it is blind to, and exactly how retirees right now, in 2026, are collecting their full Social Security benefit and paying $0 in federal income tax on it. My name is Jonathan Mercer. Every week on Tax-Free Retirement, I break down the tax rules, the hidden traps, and the strategies that protect retirees from the things nobody else is explaining. Before we go further, this is education, not personalized tax advice. Your situation is unique. Work with a CPA or a tax professional who can apply what I'm about to show you to your specific numbers. What I am giving you today is the map. A qualified professional helps you navigate it. Now let us talk about the formula the IRS has been using against retirees for over 40 years, and why almost nobody understands how it works. The IRS does not look at your Social Security benefit in isolation. It uses a formula called combined income, sometimes called provisional income. Here is how it is calculated, and this is from IRS Publication 915, which is the official worksheet for Social Security taxation. Combined income equals your adjusted gross income plus any tax-exempt interest plus 50% of your Social Security benefits. That number, that combined income figure, is what determines whether your Social Security gets taxed. Not your Social Security amount, your combined income. Here is where it gets brutal. If your combined income is below $25,000 and you are a single filer, your Social Security is completely tax-free. Above $25,000, up to 50% of your benefit becomes taxable income. Above $34,000, up to 85% of your benefit can be taxed. For married couples filing jointly, those thresholds are $32,000 and $44,000. Now here is the number that should make you angry. Congress set those thresholds in 1983 and 1993. They have never, not once, been adjusted for inflation. If the $25,000 threshold for single filers had kept up with inflation since 1983, it would be over $77,000 today. Instead, it is still $25,000. Every year, as Social Security gives retirees a cost of living adjustment, more of them cross those frozen thresholds and get hit with a tax on their own benefit. There is no letter from the IRS explaining this. There is no call from your employer. Nobody sits you down before you retire and shows you the numbers. You find out, like Barbara did, at a tax preparer's desk in March. And number 3 on my list of strategies today is the one that surprises people most, because it has nothing to do with your Social Security income at all. But first, let me show you where Barbara went wrong. Because the mistake she made is the same mistake millions of retirees make every single year. And it is not the mistake you think it is. Barbara's situation, broken down in real numbers. Her Social Security benefit, $22,080 per year. Her IRA withdrawal to cover living expenses, $30,000 per year. Now watch how the IRS combines those. Step 1. Her adjusted gross income from the IRA withdrawal, $30,000. Step 2. She had no tax-exempt bond interest, $0. Step 3. 50% of her Social Security, $11,040. Combined income, $41,040. She is $7,040 above the $34,000 upper threshold for a single filer. But here's the part most retirees miss. Crossing the upper threshold does not automatically mean the full 85% becomes taxable. The IRS worksheet calculates the exact taxable amount. In Barbara's case, roughly $10,484 of her Social Security becomes taxable. That gives her $30,000 from the IRA, plus about $10,484 in taxable Social Security, roughly $40,484 before deductions. She gets her standard deduction for being a single filer over age 65. That is $16,100 in the standard deduction, plus an additional $2,050 for being over 65. Total, $18,150. After deductions, her taxable income is roughly $22,334. Under 2026 federal tax rates, she owes approximately $2,432 in federal income tax before applying the new senior deduction. That is $2,432 per year, over 20 years of retirement. That is $48,640 gone. Not because she was reckless, not because she overspent, because she pulled from the wrong account, and the IRS formula picked it up and pulled a portion of her Social Security into her taxable income. Here is the cruel irony nobody talks about. Barbara saved her whole life. She did exactly what financial articles told her to do. She built a traditional IRA, got the tax deduction going in, and watched it grow tax-deferred. And now, every time she pulls that money out in retirement, it not only gets taxed directly, it reaches across and drags her Social Security into the taxable column as well. It feels like she is being taxed twice for doing the responsible thing. $1 from her IRA triggers a cascading event. It inflates her AGI. That inflates her combined income. That inflates the taxable portion of her Social Security. $1 in causes $2 of taxable income. And here is what she did not know. There is a type of withdrawal the IRS combined income formula cannot see. This is the fact that sounds wrong until you check it yourself. You can withdraw $50,000 from a Roth IRA, and it counts as $0 in your Social Security tax calculation. Not a deduction, not an exemption. The IRS's combined income formula simply does not count qualified Roth IRA distributions. They do not appear in your adjusted gross income. They do not appear anywhere on the combined income worksheet in IRS Publication 915. As far as the Social Security tax formula is concerned, the money never moved. This only works cleanly when the Roth distribution is qualified, generally after the Roth 5-year rule is satisfied and the retiree is at least 59 and a half. Non-qualified Roth earnings can still create tax problems, so this must be checked before anyone relies on it. Let me show you what that does to Barbara's numbers. If she had built a Roth instead of a traditional IRA, same Social Security benefit, $22,080 per year. Instead of pulling $30,000 from a traditional IRA, she pulls $30,000 from a Roth IRA. Step 1 of the combined income formula. Her adjusted gross income from Roth, $0. Step 2, tax-exempt interest, $0. Step 3, 50% of her Social Security, $11,040. Combined income, $11,040. She is $13,960 below the $25,000 lower threshold. 0% of her Social Security is taxable. She is pulling $30,000 per year from a Roth IRA, completely tax-free. She is collecting $22,080 in Social Security, completely tax-free at the federal level. She is living on $52,080 a year and paying $0 in federal income tax. That is the $0 tax secret. And before I get to the strategies that make this possible, especially the brand new 2026 deduction that most retirees still do not know exists, I want to show you what that decision is worth over a lifetime. Gerald Castillo is 66 years old. He retired at 62 from Phoenix, Arizona, where he ran an HVAC contracting business for 24 years. He did not have a pension. He had a traditional IRA with $320,000 in it and a lot of years before Social Security would make sense to claim. Between ages 62 and 65, Gerald did something that felt counterintuitive at the time. He started paying taxes voluntarily. Every year during that gap, before Medicare, before Social Security, he converted between $60,000 and $65,000 of his traditional IRA into a Roth IRA. He stayed inside the 12% federal tax bracket each year. He paid the conversion tax out of a small savings account he had set aside for this purpose. Over 3 years, he converted $185,000 to Roth. He paid roughly $22,200 in total conversion taxes across those years, all within the 12% bracket. At 66, Gerald began collecting Social Security. His benefit? $1,760 a month, $21,120 per year. He lives on his Roth distributions and his Social Security. His combined income? $10,560, far below the $25,000 threshold. His federal income tax on Social Security? 0. His federal income tax on Roth distributions? 0. He lives in Arizona. Arizona does not tax Social Security benefits at the state level. State tax on Social Security? 0. Gerald paid $22,200 in conversion taxes between 62 and 65. That was his investment. Now compare him to Barbara. Barbara pays $2,432 per year in federal income tax on her Social Security and IRA withdrawals. Over 20 years, $48,640. Gerald pays 0. Over 20 years, $0. The difference is $48,640. Gerald paid $22,200 to escape a $48,640 bill. That is a return of over $2 for every dollar he spent. Now, I know what some of you are thinking. You are thinking, I did not do Roth conversions at 62. I am already collecting Social Security. Is it too late? I want you to stay with me for exactly 2 more minutes, because the answer depends entirely on one thing. And once I explain the 3 remaining strategies, you will understand exactly where you still have room to act. The One Big Beautiful Bill Act, signed into law on July 4, 2025, created a brand new deduction for Americans aged 65 and older. For tax years 2025 through 2028, qualifying seniors can deduct an additional $6,000 per person from their taxable income. This is separate from the standard deduction. It is separate from the existing additional standard deduction for people over 65. It is available to seniors who itemize and to seniors who take the standard deduction. If you are single and over 65, your 2026 deduction shield now looks like this. Standard deduction, $16,100. Additional standard deduction for age 65 and older, $2,050. New OBBBA senior deduction, $6,000. Total, $24,150 in deductions before a single dollar of your income becomes taxable. For a married couple where both spouses are 65 or older, standard deduction of $32,200 plus $1,650 per spouse in the existing over 65 deduction. That is $3,300 total. plus $6,000 per qualifying spouse in the new OBBBA deduction. That is $12,000 total. Combined shield, $47,500. The income limit to receive the full $6,000 is a modified adjusted gross income at or below $75,000 for single filers and $150,000 for joint filers. If Barbara qualifies for the new senior deduction, that extra $6,000 deduction could reduce her federal tax bill by about $720, from roughly $2,432 to roughly $1,712. But here is the important truth about this deduction. It reduces your taxable income. It does not fix the combined income formula. It does not stop your IRA withdrawals from dragging your Social Security into taxable territory in the first place. Which brings us to the second strategy. If you are over 70 and a half and you have a traditional IRA, there is a tool the IRS allows you to use that removes income from your AGI before the combined income formula even sees it. It is called a Qualified Charitable Distribution, or QCD. Under current IRS rules, once you reach age 70 and a half, you can direct money directly from your IRA to a qualifying charity. In 2026, the annual QCD exclusion limit is listed as up to $111,000 in IRS guidance, but retirees should confirm the current limit with their IRA custodian or CPA before making the transfer. The money never passes through your hands. It never appears in your adjusted gross income. It satisfies your required minimum distribution. And because it never enters your AGI, it never appears in your combined income calculation. Every dollar you redirect via a QCD is a dollar that does not drag more of your Social Security into the taxable column. If you have a $25,000 RMD requirement in 2026 and you send $15,000 of it directly to your church, your alma mater, or any qualifying nonprofit, that $15,000 simply does not exist as far as your combined income is concerned. For a single retiree collecting $22,000 in Social Security, redirecting $15,000 through a QCD instead of taking the cash could be the exact difference between landing above the $34,000 threshold and landing below the $25,000 threshold. That is the difference between a portion of your benefit being taxable and 0%. One move, one form with your IRA custodian, and $15,000 of income becomes invisible to the formula that taxes your Social Security. Now the third strategy, and this is the counterintuitive one. Under 2026 IRS rules, if your taxable income stays below $49,450 as a single filer, or $98,900 for married couples filing jointly, your long-term capital gains are taxed at exactly 0%. For retirees who have taxable brokerage accounts with appreciated investments, this creates an extraordinary opportunity. In the right year, when your traditional IRA withdrawals are low and your combined income is already managed, you can sell appreciated stock, mutual funds, or ETFs and pay nothing in federal capital gains tax. This depends on taxable income, not total cash received, and state taxes may still apply. Done correctly, this strategy lets a married couple in 2026 realize gains up to $98,900 in taxable income at 0% federal tax. That is not a loophole. That is a legal, documented feature of the United States Tax Code. The IRS publishes it. Congress kept it in the One Big Beautiful Bill Act, and most retirees do not use it. Now here is the uncomfortable part. Margaret Okafor is 74 years old. She lives in Bloomington, Minnesota. She retired at 67. She never converted any of her traditional IRA to Roth. She is now taking required minimum distributions under the Secure 2.0 Act, which requires RMDs to begin at age 73. And those distributions are large enough that her combined income is locked above the $44,000 threshold for married filers. 85% of her Social Security is taxable every year for the rest of her life. She cannot reverse it. The RMDs are mandatory. The combined income is permanently elevated. The window she had between retiring and reaching 73, when she could have converted to Roth in smaller annual amounts, is closed. Minnesota is one of only 8 states that still tax Social Security benefits at the state level in 2026. She is paying federal tax and state tax on money she earned and saved for 32 years. Nobody warned her. But you are not Margaret. If you are between ages 55 and 72, the window is still open. The Roth conversion gap, that period between when you stop working and when your RMDs begin, is one of the most powerful tax planning periods of your entire financial life. You are in lower income years. Your traditional IRA balance is still manageable. The tax you pay on a conversion today is almost certainly lower than the tax you will pay on forced RMDs and taxable Social Security combined at a future date. The window closes when your RMDs begin at 73 under current Secure 2.0 rules. You have time, but not unlimited time. One more fact before your action checklist, and it is one most retirees never think about. As of 2026, 42 states and the District of Columbia did not tax Social Security benefits at the state level at all. Only 8 states still impose some level of state income tax on Social Security: Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. West Virginia fully eliminated its state tax on Social Security benefits in 2026, completing a 3-year phase-out. If you live in one of those 8 states, you may be paying both federal and state tax on your Social Security simultaneously. In a state that taxes Social Security, the exact state tax depends on income limits, deductions, credits, and state rules. But even a small state tax can add up significantly over a full retirement. Location is a tax decision. Not everyone can or should move, but if you are considering retirement location, this number belongs in the conversation. Here is your action checklist. 6 steps, each one completable in under 30 minutes. Step 1. Calculate your combined income right now. Take your adjusted gross income. Add any tax-exempt interest you receive. Add 50% of your annual Social Security benefit. That number is your combined income. Compare it to $25,000 if you are single, $32,000 if you are married. If you are above the threshold, your Social Security is being taxed right now. Go to irs.gov and search Publication 915 for the official worksheet. Step 2. Check if you qualify for the new 2026 OBBBA senior deduction. If you are 65 or older and your modified adjusted gross income is under $75,000 as a single filer or under $150,000 as a married couple, you may qualify for up to $6,000 per eligible person in additional deductions for 2026. Confirm with your tax preparer before you file. This deduction expires after 2028. Step 3. Ask your IRA custodian about qualified charitable distributions. If you are 70 and a half or older and you have a traditional IRA and you donate to any charity, the QCD option removes money from your AGI before the combined income formula sees it. You can do this today with a phone call or a form. The charitable donation still counts, but it is no longer counted as income. Step 4. Open a Roth conversion conversation with a CPA. If you are between ages 55 and 72 and have a traditional IRA, ask your CPA, what is the optimal annual conversion amount to stay inside the 12% federal bracket? How many years do you have before RMDs begin? What does your combined income look like at 73 if you convert nothing? These 3 questions will tell you whether a conversion plan is worth pursuing. Step 5. Verify what your state does with Social Security income. Go to your state's Department of Revenue website, or simply search your state name plus Social Security tax 2026. Confirm whether your state taxes it, And if so, at what income level? If you are near the border of a retirement decision, where to live, whether to relocate, factor this into the calculation. Step 6. Run the 20-year number. Take whatever federal and state tax you are currently paying on your Social Security annually. Multiply it by 20. Write that number down. That is what the current course costs you over a typical retirement. Then ask your CPA or financial planner. What would it cost to eliminate that? What would it take? What is the window? That one conversation could be worth tens of thousands of dollars. The system did not explain this to Barbara Thornton. Nobody sat her down before she retired and showed her what the combined income formula does. Nobody told her that a traditional IRA withdrawal reaches across and drags her Social Security into the taxable column. Nobody told her about the Roth, about the QCD, about the new senior deduction, about the 42 states that do not touch her benefit at all. She is paying $2,432 a year on money she already earned. Over 20 years, that is $48,640. That is a grandchild's university fund. That is a car. That is gone. You are watching this video right now because something told you this information existed and that you deserve to know it. Now you know. If this video helped you, hit like. It takes 1 second and it puts this in front of retirees who need these numbers and have not found them yet. Subscribe to Tax-Free Retirement so you get the next one the day it comes out. We go deeper on Roth conversions, RMD strategy, IRMAA management, and the state-by-state tax picture every single week. And drop one number in the comments that surprised you most. Just one number. 2 seconds. I read every single one. This is Jonathan Mercer with Tax-Free Retirement. I will see you in the next one.